Hey, what's going on, family? So today we're going to talk about Section 197 Intangibles. This is a very easy to do and very powerful tax deduction. This is to be used in businesses only. This can be done with partnerships, corporations. I do not suggest doing this with a Schedule C, but it's possible, right? But definitely partnerships, corporations. This is a good idea. Now, what is a 197 intangible? A 197 intangible is things that you can't hold on to, right? They're intangible. They're not hard assets. I'm going to show you just a quick list of what some of this stuff is. All right, here we go. This is from the IRS website. Now, of course, I'll put the link in the description. All right. So the following are 197 intangibles: goodwill, going concern value, workforce in place, books, records, operating systems. Look at this: patent, copyrights, formula, process, pattern, know-how, okay, or other similar items. Let's see if we can scroll down here. All right, here's some more stuff. Customer-based intangible. What that means is if you have a client list, if you have people that you know that you can do business with, that you can sell to, that is your client list. If you have potential customers in your phone, right, that is your client list, customer-based intangible. Supplier-based intangible, the plug. If you happen to have some suppliers that you have a relationship with, those things are worth money. We all understand this. The plug has always been worth money. It's valuable. It's something that you can sell to someone, but it's not a hard asset. Therefore, it's an intangible. Any franchise, trademark, or trade name, okay? A contract for the use of or term interest in any item on this list. So what that means is if you have a contract with a supplier or a contract with an employee, okay? Look at this: a covenant not to compete, right? Simply having a covenant not to compete with someone is valuable. That has a monetary value and it can be deducted. Now, how does that work? Here we go. We're gonna go over here, and this is the one I wanted to show you. But anyway, it's 15 years. Okay, you amortize the value of this thing over 15 years, and what that means is, let's say, just to keep things simple, let's say you have a special skill. Let's say it's DJing, right? And you have some know-how on how to do that. That know-how has value. All right, it has value. It's worth something, and you have to figure out how to value that thing. Okay, whatever it's worth, you simply take that number and divide it by 15, and that's going to be a deduction for you every single year for the next 15 years. Okay. All right. Very quickly, I want to show you part of this whole thing. This is called anti-churning rules. Okay. What this simply says is that in order to amortize these 197 intangibles, there has to either be a significant change in ownership or use. Okay, you want to make sure you get that. It must be acquired, them, didn't result in a significant change in ownership or use. Let's look at that again. It says anti-churning rules prevent you from amortizing most Section 197 intangibles if the transaction in which you acquired them did not result in a significant change in ownership or use. And right there is the biggest part right there: use. So think about it. When you have personal assets and then they become business assets, that is a significant change in use. And that is what gives you the go-ahead to amortize this stuff, okay? Under the anti rules, you can't use the 15-year amortization for the intangible if any of the following conditions apply. You or a related person held or used the intangible at any time from 91 through 93. Okay. You acquired the intangible from a person who held it at any time during the period in as part of the transaction the user did not change. What if you granted the right to use the intangible to a person or related person who held or used at any time during the period? This applies only if the transaction in which you granted the right and the transaction in which you acquired the intangible are part of a series of related transactions. Okay, so all this stuff has to do with how the intangible was used prior to it being used for business. Okay. And so again, what that means is if that client list was never used for business, right? But now it is, that's your intangible asset. It only makes sense. Think about this for a second. If you have a bunch of friends, just friends, family, bunch of friends, you have not been in business before. You go into business, and now these family and friends become potential clients for your business. Aren't those family and friends worth money? Of course they are. Now the question becomes, how much would you sell your client list to me for? So that's a real question, because you can actually go out and buy client list online. You can buy people's names and phone numbers and addresses and email addresses online all day long. So it has value. So once you know that value, again, you simply divide that by 15, and that gives you right here a 15-year amortization. So every year, take that value, divide it by 15, and you're able to deduct that on your taxes every single year. All right? It's a very simple thing to do that a lot of people just don't know about. And when I bring it up to my clients, they think I'm a genius, right? But it's just really just understanding this stuff and reading, right? So again, all this stuff that I showed you today, I'm going to put this in the link on the page so you can read it for yourself. The anti-churning rules, the items that is included in the 197 intangible list. Both of these things are coming from the IRS. All right, section 197 intangibles. Holla.